Which is the better investment, the well-located older property or the newer property in the growing part of town? You might be surprised by the answer. So I've invested in both older and newer properties, and I want to share what I have learned that might help you become a better real estate investor. Welcome to Strategy Saturday. I'm Carillo, and today we're going to discuss one of the most significant decisions real estate investors face, whether to invest in older properties or newly built properties. So let's get started. One of real estate investors' most important choices is whether to purchase newer or older properties. The terms alone can be very subjective. When I began investing in real estate in Connecticut, I purchased properties built in the early 1900s, which I considered old. When I moved to Florida, people considered properties built in the 1960s old. And like most decisions, there's always pros and cons, and I'm going to break down what I feel are some of the most important points that investors should take into consideration when making this decision. So first off, it's the purchase price, which is obvious. It's what most people probably see first. And it's this obvious benefit of older properties is that they're less expensive than newer ones. And it's typical for older properties to be sold for less than replacement value. In other words, you would not be able to build that property you are buying for the price you are paying. Next is maintenance, repairs, and management. And the trade-off with paying less initially for an older property is usually higher maintenance and repair costs. Management in general becomes more expensive with older properties as well. Many older properties with deferred maintenance will need to scale back their tenant screening efforts to keep units rented. This translates into higher management costs for tenants breaking leases, evictions, unit make ready, marketing, and leasing costs. Furthermore, older properties will require larger reserve budget for maintenance and repairs, even if the property is fully rented to great tenants. On the other hand, newer properties are usually built with better materials that won't need attention for decades. Now, some examples of problems notorious with older properties would be sewer line issues, electrical issues that require updating to code, or for instance, plumbing that has been patched over the years and never really corrected. The next part is appreciation potential. Now, location is one of the main driving forces of appreciation. Older properties in gentrifying areas or more desirable central locations might be great investments if the owner is willing to invest capital and time, compared to newer properties in developing areas where appreciation takes off if there are the same market demand drivers. Next is insurance and financing. Now, the older the property, the harder it is to get insured and or the more hoops you need to jump through. Now, when I owned properties that were 100 plus years old, every year when lease renewals came through, it usually came with an insurance increase and sometimes a couple of items that need to be repaired, such as fixing stairs or the sidewalk, etc. And as an owner, I was happy they renewed it, and I just had to make these changes. But I also was dropped several times. So every time the renewal came by, it was kind of a relief, but sometimes it came with a couple caveats, which you had to kind of repair, refix, whatever it might be, before they would actually do it. You might get those like a couple months before the renewal date. Now, financing is usually not that big of an issue with older properties, but it is much easier to get financing for newer properties since lenders are not afraid that borrowers will become burdened with repairs and either let the property fall into disrepair or not pay their mortgage or both. And working with local lenders usually makes financing easier since they understand and they believe in the market that they're lending in, which is where you're buying and investing into. Next is collections. And I spoke with a partner of a large multifamily private equity firm years back, and I remember them saying that as properties age, their collections usually decrease as well. And this is a very broad statement. And of course, if we're buying older apartment buildings in some expensive areas of Manhattan or Boston, this might not hold true. Still, their methodology was that when you focus on newer properties, you can attract better credit tenants than older properties. And better tenants typically equate to a more predictable cash flow. Now, as properties age, they will usually drop in class from A to B, B to C. And if the property is not maintained or renovated, it'll just continue. And the whole value add model is based on renovating C-class properties and bringing them to, say, a B level. However, the location of the property and the market are usually the determining factors in determining whether this is actually even feasible. Now, next is the business plan in general. What is your business plan for the property? If you keep an older property for 10 plus years, it will require some significant CapEx, capital expenditures. If you do not want to handle this, maybe buying newer properties is a better route to take. Still, it is also might make sense to perform those renovations every 10 years when you refinance to maximize the value of your property. So typically when you refinance out, if you're doing it, say 5, 10 years, definitely 10 years, you're going to have built some equity in the property and you can take some of that out. You can reinvest into your property to repair anything that needs to be done, update anything that's going to increase rents. And that's really the great thing about commercial mortgages, where you're going to have that balloon and you can kind of refinance everything, pull some cash out, make the property property better, and go on. Next part here is resale. So who will purchase a property after you complete your business plan? If it is a newly built, it might be easier to find a buyer than an older property. And selling an older property in a market, and especially a down market, might make selling harder. There's a reason why institutional investors typically focus on purchasing larger and newer apartment buildings, more predictable cash flows, and easier to finance and sell. Now, for investors looking for a higher return who are not deterred by the more time-intensive nature of older properties, that might be the best route. On the other hand, for investors looking for a more streamlined real estate investment approach, purchasing a newer property will probably be a better fit for their portfolio. The usual progression I see with real estate investors is that they begin buying newer properties in better locations as they grow, and that's exactly what I did. I started with older properties, and little by little, I've grown to just buying properties as 1980s, 1990s, and newer now. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
You always want to invest in real estate, but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.